So hi everyone. So today in this session we are going to complete the second part of the lecture on securities analysis. In the first part we have completed the concept relating to exponential moving averages. Now in this session we are going to complete the concept of efficient market hypothesis. Okay, name of the concept is efficient market hypothesis. How to understand this efficient market hypothesis, logic behind it, everything let us try to understand. From the exponential moving averages concept, what we understood, let's have a look into that first. From the exponential moving averages concept, what we learned typically is whenever there is a price movement of the share, we should not consider directly the share prices which shows extreme rise and extreme fall, which does not give a right opinion on a particular company stock. We should not consider extremes, we should consider average. When you consider a typically a static average, it won't have any rise or fall, it will be a line. Therefore, it is wrong to take extreme falls and highs. It is even wrong to take a static average. Therefore, people thought that we should not consider a static average. We should not even consider a total actual prices moving fall and up and down. We should consider average. When it comes to average, it should not be static, it should not be direct. Therefore, what they thought, they brought a concept called as a moving average. Which average? Moving average. We move periods after periods, days after days. Means when an information of 15 days data is given, we will take 5-day data, average it. 6th day will be next 5 days, like that we take average. That's a 5-day moving average, 6-day moving average, like that. In that moving average, daily moving average also we can take, which will be typically called as an exponential moving average, which considers a error also inside it. Okay, your forecast and actual, there will be a difference. That difference we call as an error. Error is represented by a number called as at minus 1 minus ft minus 1, means actual for the period before and forecasted amount for the period before into an exponent called as an alpha. Alpha is called as a smoothening exponent. Okay, that's what we understood. Once after completion of that particular concept, exponential calculation, once it is completed, then we went into the next area called as understanding and calculating the moving average for a daily basis. What is the formula? FT, forecast for the period, equal to forecast for the previous period, FT minus 1, okay, FT minus 1 plus AT minus 1 minus FT minus 1 into alpha. We got a moving average for all the days, we calculated accordingly and we completed. This is what we have done in the last particular problem with regard to the moving averages, also called as an exponential moving average. Now, we are moving on to the next area called as efficient market hypothesis. What is the concept? Efficient market hypothesis. Let us see the screen. First, let me explain what is this efficient market hypothesis. In efficient market hypothesis, we are going to understand one concept called as efficiency in the market. What is it? Efficiency in the market. Whether markets are efficient or inefficient, we are going to understand using a concept called as efficient market hypothesis. Okay, I will put this concept very fast. Okay, from the exam's point of view, if a question comes, how to answer, 8 marks questions will come on this. 8 marks if you have to get. Listen to the explanation for the next 15 minutes. Do the problem. That's all. You will be done with this concept. Okay. Next 45 minutes, I am going to complete full concept of security analysis chapter. This part will be the last part. Efficient market hypothesis we will cover. Once this is completed, run test and serial correlation test. One question is there which was tested for 8 marks in exam. That also we will do and we will complete it. Okay. See the screen. Let us consider a company, X Limited, and observe the share price movements in last days. How many last days? 10 last days. Day 1 to day 10. These are the actual prices. 100 is the price 10 days before. 145 is a price 1 day before. Okay. Like that we went back for 10 days. Graphical presentation also given. How to understand? 100, 105, 110, 115, 120, 125, 130, 145, 145. 140, 145. Means what? As the days are passing by, okay, as the days are passing by, prices are going on increasing, okay. That means over the last 10 days, day 1 it started with 100, one day before 145 it ended, means the graph is running like this, okay. From this what you can understand, okay. Sorry, understanding also you keep away. First let me explain the concept. My duty is to first properly give the concept, after that problems can be completed in no time. From this what you can understand, prices of the shares are moving every single day. Over a 10-day period, the pattern of the share is in such a way, it is growing. Simply the prices are rising every single day. That is what the interpretation we can do from this. Okay, one point completed. By the way, x-axis la days, y-axis la prices. So it is going on increasing every single day. Interpretations later. First let us see the graph. Let us consider another example to understand patterned rise and fall, okay, for Y Limited. This is for which company? X Limited. This is for Y Limited. We analyzed another company stock also, okay. This is which company? Y. 100, 110, 120, 130, 140 rise. First 5 days la rise, G raised. Suddenly 135, 115, 110 it fall, okay. Again it raised, 131, 142, 151, 160, 165 it went, 171. Again it fall to 162. Means there is a raise, there is a fall, there is a raise, there is a fall, okay. This is how this particular stock is behaving. This is the behavior of this stock. Which company stock? Y Limited. No interpretations I am making first. Let me put the concept before you. Next, third case, there is another company. Let us say this company is which company? Z Limited. Z Limited pattern is like this: 100, 110, 105, 115, 92, 98, 93, 120, 107, 119. Like this it is moving up and down, okay. This is the third type of company. So how many types of company stocks we are analyzing? 3 types of companies we are analyzing, wherein first company pattern is like this, second company pattern is like this, third company chart patterns are like this. This is called as a charting analysis. This is called as what analysis? Charting analysis. Charting analysis is a concept where when you observe the markets on a daily basis, on the basis of the charts and price movements, one can buy and one can sell and make a obvious gains out of buying and selling. Sir, I didn't understand. I will put it in a simple way to understand. See here. Analyzing the charts. Which charts? Analyzing the price movement charts and taking a decision as to buy or sell and making a gain out of it is called as technical analysis. Is called as a technical analysis. There are 2 types of analysis of stocks. One, fundamental analysis. Second one, technical analysis. Understanding the company's past, forecasting the company's future, understanding the news related to the company, analyzing the company's ratios, analyzing the company's assets quantum, analyzing the company's interim balance sheet and P&L, analyzing the company profits, analyzing the company's projects, analyzing the company's technologies, analyzing the management skill. All these things if you are understanding, on the basis of this if you buy the stock, this is called as a fundamental analysis. Second, forgetting about everything about company, only the price movements we are watching, pattern of price movements. Today increase, tomorrow increase, day after tomorrow increase, last 10 days la increase, okay. When there is a increasing trend to the stock like this, what does it mean? Various days ki this is the price, correct? Means what? You can buy here, sell here, again 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 buy here, sell here, okay. That means what is happening? You are buying at a lower price, selling at a higher price. Again you are buying at a lower price, selling at a higher price. Again you are buying at a lower price, selling at a higher price. Like that, throughout the line, what is a pattern? It is raising every single day. Means what? You can buy when the price is low, you can sell when the price is high. On the basis of chart, you can tell directly that buy when the prices are falling, buy when the price is there, and sell when the prices are rising. Means what? Where to buy the share? Here, where to buy the share? Wherever you want, you buy. Definitely you will get a gain because price is going to increase. Price is going to increase. Who said? Chart said. That's called as a technical analysis. Technical analysis is an analysis where buying and selling decision is taken not on the basis of fundamental analysis but on the basis of a technical analysis you are doing. Okay, that means profits can be made. What is that? Profits can be made just by analyzing the chart. Just by analyzing the chart. Means by analyzing the lines and chart, you can just like that tell that when to buy and when to sell. This is called as a technical analysis type 1 data. Type 1 data. Data type 2. Data type 2. This is called as a pattern rise and fall in the stock market language. Let us understand how this stock is behaving. Let us see. This stock will rise. When it rises, it won't fall immediately or it won't rise continuously. When it rises, it raises for some length of time. Okay. When it is rising, you will buy. When it is rising, whenever it is rising, for example, it is rising for 4-5 days. When rise happen, rise will continue for some number of days. Here, once rise started, rise will continue forever. Rarely happening. Here, whenever there is a market rise, okay, whenever there is a market rise, that rise will not stop with one day. For next to 4-5 days, rise will be there. So, whenever this company is there, how technical analysis can be made? Whenever rise started, next to 3-4 days, bonanza profits you can make. So, slowly prices will rise. Okay, next. Once it start falling, fall is not temporary, it will be permanent for another 4-5 days. Like this, the price will fall. At any of these timings, you should not, okay, you should not technically sell the share because you already bought the share. Don't sell it this time. If you want, you buy at a lower price, no problem. During this period, buy here, sell here, buy here, sell here. Okay, at this price you bought. At this price you bought. Now what to do? Prices are falling, don't sell, you will incur loss. Therefore, wait till the market rises again. Wait till the market rises again. Once the market rises, start selling your share again. Means, how to understand the chart using this? Y limited stock, how it is behaving over a past 10-15 days period. When it starts rising, raise will not be temporary. See here, green color line raise. It's not for one day, it continuously raised. Then it fall, it won't fall for one day. It fall for continuous another 4-5 days. When it rise again, another for 4-5 days, it will again rise. Again when it falls for another 4-5 days. That means whatever happens, that will happen for some length of time. Means what? If it rise is not like this. Today it will rise, tomorrow fall, today rise, tomorrow fall, again rise, again fall. Like that it will not happen. This graph is very easily understandable where once rise started, that rise will be continuous for another 4-5 days. At any point of time, you can buy and sell intraday and you can make a gain. Or you purchase, markets are falling, fall will be for another 4-5 days. Sit calm, don't sell anything. If you want, you buy. Okay, again the prices will rise. Okay, and when the prices are raised peak, you sell at any point of time, you will get the profit. Once a fall is experienced, that fall is again continuous for some number of days. Okay, so from this, by seeing this diagram, can I take a decision as to buying and selling? Yes. This is also another type of technical analysis. This is called as a pattern rise and pattern fall. Third category. Let us consider another example of Z Limited to experience another rise or fall. Here let us see what happened. 100, 110, 105. 100, 110. Rise is there. Fall. Rise is there. Fall. Rise. Fall. Rise. Fall. Rise. Like this the patterns are. That means zigzag patterns of this company stock is moving. Okay. Zigzag patterns of this is moving. In this, can you take a decision like this and like this? Here, buy anywhere, sell anywhere, you will get a gain. Here, buy when the prices are, okay, buy in a rising trend, buy at a lower price, sell at a higher price. Like that I can tell. Or when the prices are falling, you buy. When prices rises, you sell. You will get an obvious gain. Like that I can tell. Here can you tell like that? Here there is a pattern like that. Huh? Yes. Here also pattern is there. Do you know what does it mean? When prices rise will not be permanent for 4-5 days. Rise will happen today. Do intraday trading here. When rise is there, full day there will be a rise. Full day there will be a rise. 1 or 2 minutes in fall may be there, but when rise comes, throughout the day rise will be there. Intraday you can make a bumper gain. Bonanza profits you can make during the intraday trading. Okay, fall happens now, that fall is not permanent, so don't do any intraday transaction. Wait for 2-3 days and then sell, because the prices will definitely rise after a fall. Okay, whenever there is a fall, there is a definite rise. 1 day gap may be there, but rise will be definite, 100%. See here what happened. Rise is there, fall is there, but again rise is there, fall is there, again rise is there, fall is there, again rise is there, fall is there, again rise is there. Means what? Every rise is experienced by immediate fall. Every fall is experienced by immediate gain. Whenever you bought at a particular place, markets are rising. When rising is there, sell it, because definitely next day it will fall. 1 day rise, 1 day fall, 1 day rise, 1 day fall. Means buy when the prices are falling, sell when the prices are rising. That's all. In daily this will happen. Therefore, from this also I can predict what will happen in the future. Okay, from this entire discussion what we understood, using the charts, if you can make some analysis and invest and make a obvious gains, that concept of analyzing the charts to invest and make profit, we call it as a technical analysis. We call it as what analysis? Technical analysis. Okay, technical analysis. Whatever I discussed now, I put it in the form of text as well. Take a minute time and read it first. Please put your time on this. Once you understand this clearly, no one can stop you in exam. Problems also will be complete in no time. Completed. So from this one conclusion has to be drawn. Why we are discussing about all these? Whenever there is a rise, there is a fall. Whenever there is a fall, there will be a rise. By just analyzing this rise and fall patterns, one can make an investment. If a person can make investment just by analyzing the patterns of rise and fall and make a gain confirm, we call it as inefficient markets. We call it as inefficient markets. Inefficient market is a market where, I repeat, inefficient market is a market where profits can be made or a trade is possible just by making the predictions on the basis of the charts. If the charts itself is enough to analyze the stock and buy and sell and make profits, we call such market as an inefficient market. Sir, why is it inefficient? Because markets are efficient if even though a person know about the technical analysis, he should not get the gain. Profits should come by way of understanding fundamental, technical and luck factor. All these should work together because luck here represents what? Demand and supply forces you can't control. Okay, number of buyers and number of sellers today determines about the prices of the share today. No buying, no selling. Yesterday price and today's price will be same. When buyers and sellers are coming, then the prices will change. Then how can you predict? You don't know how many number of buyers and sellers will participate. Then how can you predict how the markets are? Okay, and if your predictions are coming true even without knowing that, how you can tell that you are having an efficient way of analyzing the stock? That's why people call the markets in such a case as inefficient market. Inefficient market is a market where buying and selling happens or a profit happens just by analyzing the charts and the technicalities inside the charts. Such market is called as a inefficient market. Okay, please read the notes I have given. This notes is very important. Please take a minute time, spend your time, read it properly once. Okay, next. Let us see. As per pharma, there is a person called as economist called as a pharma. There are two types of markets. One is efficient, another one is inefficient market. One is efficient market, another one is a inefficient market. What is efficient market? What is inefficient market? Let us understand first. So what is an efficient market? What is an inefficient market? Let us first try to understand. Inefficient markets, already I told you. Profits are made simply by making technical analysis of the stocks. If the technical analysis fails, market becomes efficient. If the technical analysis fails, market becomes efficient. Next, efficient markets. Which market? Efficient markets. Efficient markets are of three types: weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. Weak form of efficiency, I will first explain, after that you can read. Weak form, semi-strong and strong. Weak efficiency market, what does it mean? Means technical analysis will fail. What will fail? Technical analysis will fail. Means just by seeing the charts, if you invest, that's all, begging bowl will come in hand. So that such a situation is called as a technical analysis fail. Means just by making technical analysis of the company stocks, you can't invest. Means by pattern, if you go, last week this is how the pattern. Therefore, last week what happened? Whenever there is a rise, there is an immediate fall. Whenever there is immediate fall, there is an immediate rise. Therefore, I will buy when the prices are falling, because definitely in another 3-4 days it will rise. As per the past trend, okay, prices are falling. I invested for the next 20 days, never it raised. Means your technical analysis failed. Such a kind of situations is called as efficient. Why efficient? Because our markets are running as per demand and supply, not as per patterns. So from this what you understand, markets are efficient. Markets are efficient. So sir, when technical analysis fail, with what I should make profit? Fundamental analysis will work. Means understanding the company's projects, profit, sales, etc. All the internal companies, if you analyze, you can understand whether prices are rising or falling. Mean a situation where technical analysis fail, but fundamental analysis work, is called as a weak form of efficiency. That means still you can analyze on the basis of fundamental analysis. So who read the fundamentals of company, who know about the rudimentaries of company, can easily make a profit. Again, markets are not driven by profits, demand and supply. It is run by fundamental analysis. Okay, that means people who have a knowledge of fundamental analysis, ratios analysis, etc., will make a bonanza profits out of it. So this is also efficient. Technical analysis file efficient, but fundamental analysis is giving me a profit. Efficient but weak form of efficiency. Okay. Second, semi-strong market of efficiency is such a market where technical analysis fail. What will fail? Technical analysis utter flop. Fundamental analysis also will fail. First one, what will fail? Technical analysis fail. Secondly, what will fail? Fundamental analysis also fail. Technical analysis fail, fundamental analysis fail. Then what will win? Technically fail, fundamentally fail. Then what will win? Then the only way of making profit, fraudulent, but the only way of making profit is insider trading. Which trading? Insider trade. This is not given by me, study material, it is there, if you want you can go and read. Okay, that means only if a person has insider information, and before even market come to know about it, if you know that and take a action before it happens, then you can make a gain. For example, I will take a call option. I know that my company share price is going to rise. I know that. I will enter into a futures buy contract now. I take a futures buy position. I know that after 1 month prices will rise. I am a director of a company. My company is going to get a very big government contract, which is not known to public as of now. Board of directors know that. I am managing director. Okay, I am a managing director. What I will do is, I will be knowing about that information well in advance, before even the world knows. Okay, now what I will do is, knowing about that government contract coming to us, awarding to us, I will enter into a futures buy. After 1 month. Futures buy, if you click, you will really buy take a counter sell. At the time when I take a counter sell, prices will rise. I will get an obvious margin gain. This is how you can make a profit. This is unethical and incorrect as well. But the only way is only that. Such a kind of situation where technical analysis fail, fundamental analysis also fail, but insider trading will give you a profit. That's called as a strong efficiency, but semi-strong. Okay. Strong form. Technical analysis fail, fundamental analysis fail. Insider trading also you cannot do. Even insider trading means future we are predicting. It went reverse. Okay. So technical analysis fail, fundamental analysis fail, insider trading also not working. Prices are randomly moving here and there. Such a kind of situations are called as strong form of efficiency. Read the notes. I am putting it before you. Read the notes. Completed? Hopefully everyone completed the concept. Okay. So now we understood what are efficient and inefficient markets. Now we are going to do one problem which is there in your study material as well. That problem is dependent on understanding the efficiency of the market. Means whether a particular stock is efficient or inefficient. Means patterns are enough to buy and sell the stock, or is there anything other than that to analyze it. Okay. Efficient market hypothesis. Let us understand one by one. First, some technical terms are there. Let us understand. There is a concept called as a runs. There is a concept called as what? Runs. What is this run? Runs means number of times the direction of the share price. Number of times direction of the share price changes. Okay. Share price changes will be called as a run. Share price changes will be called as a run. Symbol of increase and decrease will be given. Symbol of increase and decrease will be given. See here, like this. Symbols will be given. How? Let me explain you the concept. So, number of times the direction of a share price changes is called as a run. Symbols will be plus and minus symbols will be given. How to understand inefficiency? Whether to, I will give you an example here. Okay, chart 1 let us take. Chart 1 let us take. See there. If you observe clearly, there are 3 types of charts. I will roughly draw here. I don't want to show you the answer and tell. I will manually do it and I will explain. More comfortably you can understand. See here. First example, it is like this. Means, if you take the daily tracking of prices, there is a rise. That's all. Rising every single day. Now, how many runs are there? There is only one run. What is that run? This is called as a rally. In a real life scenario, they call it a rally. Rally means a run going on increasing every day. There is a rally. So, this is called as a run. Single run is there. So, there are 5, sir. 5 runs are not there. 5 changes are there. All 5 changes together, we call it as a one run. Okay. Next. This is how one is. Plus, 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 plus. This is all run 1. Next, minus, minus, minus. This is all run 2. Plus, plus, run 3. Like this. So, these all pluses together will be called as one run. There are multiple runs here. 1, 2, 3, 4. 4 runs are there. Example, let us take. Next, there is a zigzag pattern like this. Okay, here run 1, run 2, run 3, run 4, run 5, run 6, run 7, run 8, run 9, run 10, run 11, like that. 10 days data la, there are 10 runs totally. Here 10 days data la, only 4 are there. Example, our original chart is like this. Only there are 1, 2, 3. 3 runs are there. Here there is only 1 run. Okay. In the 3 cases, whatever we analyzed before, I said technical analysis that we can get through. What I said here, using these charts, what I said, easy to make profit like this. Why? Every day once the price rises, it rises continuously for next to 4-5 months. You forget. Here, whenever there is a rise, that rise is constant for another 5-6 days. Okay. Next. Here if you see, this is run 1. How many days you have taken? 15 days la, how many runs are there? 1 run, 2, 3, 4. 4 runs are there. 15 days ki 4 times only changes happened. From this what you have to understand? There is a 4 run trend only passing on for every 15 days. Means 15 days la 4 only happened. 15 days la 4 only happened. What do you mean by 15 days la 4 only happened? 15 days la 4 happened means out of 100 data if you take, okay, out of 100 data if you take 4 out of 15. 4 out of 15 means technically if you have to understand not even 30%. Not even 30%. 15 and 30% means 4.5. 4 times means 30% of the times only there will be a change. Are you understanding? Means again another 70% there is only rise. It go on rising, it will fall, again it will rise. Means every 15 days, 30% chance is there that it will change. 70% whatever starts, that continues for some number of days. Means there are only 4 runs here. Okay, lesser runs. This is no runs, only 1 run is there. This is lesser runs. This is higher runs. 1, 2, 3, 4, 5, 6, 7, 8, 9. Means in 10 days, 9 times runs are happened. Yeah. From this, what you have to understand? When the runs are, listen carefully how the concept came. When the number of runs are either too low or when the number of runs are either too high, when the number of runs are too low, like first and second case, or when the number of runs are too high, like in the third case, technical analysis is possible. Sir, I didn't understand. See here. When there is no runs or number of runs are very less, easy to predict what will happen. When the number of runs are extremely high, then what will happen? Run represents what? Plus when it is there, minus also will come. 10 days key, 9 runs are there, means what does it mean? One day rise, one day fall, one day rise, one day fall, one day rise, one day fall. Here also there is a prediction. By when the price are rising, immediately next day it will fall. That trend is also available. Therefore, to make the share unpredictable, to make the share efficient, okay, passing away from the guessable state, it should be efficient. Means the number of runs taken by a particular share should not be too high, should not be too low. It should be average runs. It should be average runs. From here the concept started. Please listen. In order to tell that a particular share is efficient, the number of runs should not be too high, should not be too low, should not be too high, should not be too low. It should be average number of runs. Okay. So say for example, 10 days we have taken the data. Data of how many days? 10 days. 10 days are 9 times change. 9 times what change? Price change is not there. Runs change is there. Run means plus become minus, minus become plus is a run. Plus is there. It became minus, run 1. Minus became plus, run 2. Minus became plus means fall, again rise, fall, again rise. 10 days or 9 days run change means every day there is a rise, next day fall, rise, fall, rise, fall. Like that it is starting. That means what is the indication here? Are buy today, sell tomorrow, buy today, sell tomorrow, or sell today, buy tomorrow. Like that the question answer is. That means if the number of runs are too low, only 1 run or 2 runs are there. If the runs are too high, market becomes predictable. Market becomes predictable. When the prices are having average amount of runs, average amount of runs means what? When it will rise, when it will fall, no one will know. 15 days data I have taken. 15 days data I have taken. 7 times runs happened. Means what? 7 times runs have happened. And 7 times runs also patternless runs. One day rise, one day fall, one day rise, suddenly fall, again rise, fall, again fall, again rise and again fall. Like this unpatterned rise and fall happened. In this case, the share price becomes more unpredictable. When pricing is unpredictable using technical analysis like this, then we tell that markets are efficient. So what we have to calculate in the question now, what we have to calculate is we need to know how much amount of runs will be called as a average runs. How many amount of runs will be called as a average runs? How much is the average? Formulas are there from here. I am not going deep into the statistical derivations, but financial logic I will explain one by one. Okay. See here. How to conclude inefficiency? X limited, if you observe, plus, there is only 1 run. There are only 5 runs out of 15 runs. There are 10 runs out of all the 10. Means one day rise, another day fall. Rise, fall, rise, fall, rise, fall, rise, fall. Like means buy today, sell tomorrow, or sell today, buy tomorrow, like that. Inefficiency due to low runs, inefficiency due to high number of runs. Like conclusion. Conclusion is market is said to be efficient if the number of runs are not too high. If the number of runs are not too low, but it should be average, then predictability through technical analysis becomes impossible. When we take an average, it is an approximate number. This is important here. Portfolio management we have done mean. How to tell? Yeah, here 1, 2, 3, 4, 5. You will take some number 6%, 7%, 5%, 8%, 7%, like this we will take. we will add all these, we will get some number. Let's say 30 we got. 30 divided by 5 you will take. Means 30 divided by 5 means 6. 6 minus 6 deviation 0. Okay. 7 minus 6 deviation is plus 1. Okay. So 6 minus 6 0. 7 minus 6 1. 5 minus 6 minus 1. 8 minus 6 2. 7 minus 6 1. Like this we will take now. We will take deviations x minus x bar. This is x bar. This is x minus x bar. X minus x bar whole square will calculate. Standard deviation will calculate. Standard deviation 3 we got. What do you mean by standard deviation? What I said in portfolio management, standard deviation is not a negative thing. It's not even a positive thing. It's both positive and negative. Mean came to 6. Mean came to 6. Standard deviation means if you take a standard normal table, mean happens to be 6. This 6 can be raised by 3 and become 9. Okay? Become 9. This 6 can go other side and may also become 3. Means what? Means your average has a limit. Lower limit, upper limit. Means your average is 6. I don't deny with that. Average 6. But that average has a deviation. That's not 100% guaranteed average. That average will have a deviation. It can move to the left side and become 3. It can move to the right side and become 9. Means lower limit is 3, upper limit is 9. This is called as limited. This is called as a limited or range average. This is a range average. Portfolio chapter throughout what you will do? Averages with ranges. Standard deviation is a range. It's a range average. What do you mean range average? It's not an absolute average. It is a range average. Okay. It is a range average. Means what? If you take average and deviation, there is a deviation for that or not? Standard deviation came. How much? 3. What do you mean by 3? 6 can go up to 3. 6 can even go up to 9. Okay. On the basis of past information, we calculated this. From this, what you have to understand, average is not one number. Average is a range of numbers. Average is a range of number. A particular stock gave me a mean return of 6. Mean return of 6. What is average return? 6%. Wrong. This 6 can go up to 3. This 6 can go up to 9. Therefore, the return given by this security will be 3% to 9%. In between anything it can give. Average is 6. Average is 6. But actually it can even go down to 3 or go up by 9. Anything it can happen. Like that, here also we are not going to calculate an absolute average. We are going to take a range average. Which average? Range average. Means what? We will take number of runs. We will take number of runs. Okay. We will take an average. Average means what? Mean you will calculate. You will get one average number or not. We are not going to take that average. We are going to take another number called as a standard deviation. For that average, we will add standard deviation. For that average, we will deduct standard deviation. Deducted is called as a lowest average. Highest is called as a highest average. But formula is mean. Mean is represented by x bar. Now here it is represented by a Greek term called as a mu. It's like u with a tail to the left side. Mu. Mu minus sigma into t will be there. I didn't write here into t because more complication. So therefore, in the problem directly I have done. When we take average, it is an approximate number. It lacks accuracy and therefore it has a standard deviation. Therefore, we will consider two averages. Lowest average, highest average. Lowest average, mean minus sigma. Highest average will be mean plus sigma. Okay. So, notations used in EMH. Number of observations with positive change. Okay. Means what? 100 became 110 plus. 120 became 110 became 120 plus. 120 became 90 minus. 90 became 80 minus. 80 became 65 minus. 65 became 92 plus. 92 became 95 plus. How many runs are there? These 2 run 1, these 3 run 2, these 2 run 3. Number of positive changes is called as runs. Number of positive changes, N1. Okay, that's called as N1, positive changes. 1, 2, 3, 4 is called as N1. Negative 1, 2, 3. Okay, total 7 la 4 times rise, 3 times fall. Runs 1, 2, 3, number of runs. Now we need to know that these 3 runs is average or it is above or below the average. Okay, first average is represented by mu. Mu has a formula. What is the formula? 2 into n1 plus n2 divided by n1 plus m2 by plus 1. Statistical formula, follow that and do. Remember the formula. This is not a time to learn about derivations of this. Formula, mu 2 n1 n2 divided by n1 plus n2 means total observations plus 1. 2 n1 n2. 2 into n1, 4 into 3 divided by 4 plus 3, 7 plus 1. Okay, va? So how much will be the answer? 2 into 4 into 3 divided by 4 plus 3, it is 4.43. Technically 4.43 not possible now, we will take the answer as 4. So average is 4 runs. Average is 4 runs. How much we got? 3. So it is average or not an average? Don't see like that. We have to calculate standard deviation and then we have to calculate the range. Within that range, whether these 3 runs are falling or not, we should check. Standard deviation denoted by sigma is calculated as under sigma equal to root of 2n1 n2 into 2n1 n2 minus n1 minus n2 whole divided by n1 plus n2 whole square into n1 plus n2 minus 1. I can't do anything, you have to remember that. Okay, this is not a time to learn about the statistical derivations of this formula. Okay, it's none of our business at this time. Just understand 2 formula you need to remember here. Number 1, mu 2n1 n2 divided by n1 plus n2 plus 1 point, and standard deviation root of 2n1 n2 into 2n1 n2 minus n1 minus n2 whole divided by n1 plus n2 whole square into n1 plus n2 minus 1. This is a formula. Put the numbers in that, you will get a standard deviation. Okay, let us say standard deviation is 3. I am directly taking this example. Standard deviation is how much? 3. Mu minus standard deviation 4 we got, minus 3 1, 4 plus 3 7. It should be within, the number of runs should be within 1 and 7. Here number of runs are within what? How many? 3. 3 is within 1 and 7 or not? It means if the number of runs are between 1 and 7, then we consider market as efficient. Okay, for simplicity's sake we ignore t. Actually this is mu minus sigma into t will come. T means normal distribution table numbers they will give in the question. Okay, t means a t distribution will be given in the question. Calculations will be made at different levels. Okay, different levels of significance. What is the level of significance, that I will show you while doing a question. This is all we have to calculate in efficient market hypothesis. Okay, last 10 minutes we'll close this particular area. ICAI question. Okay, date. They have given so many days information, 1 to 31 they have given the information with appropriate holidays in the middle. Okay, closing index values also they have given you. Using this they are asking us to calculate whether markets are efficient or not. Directly we can do here. 2800 became 27, minus plus plus minus plus, like that we have to do the numericals. 2880 became 2800 became 2780, minus 2780 became 2795, plus plus minus plus 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 2829323334. Okay, minus minus plus minus 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 plus. Okay, now tell me, runs, run 1, I will use another ink, 1 2 3 4 5 6 7 8. How many runs are there? 8 runs are there. Whether these runs are average or not in average, we have to calculate. 2n1 n2 formula I said that we have to use and calculate the mu. Mu represents what? Average. Just a minute. 8 runs are there. Let us check the final answer whether runs are correct or not. That's all. Number of runs is 8. N1, how many times pluses are there? 1 2 3 4 5 6 7 8 9 10 11. 11 times plus is there. Minus 1 2 3 4 5 6 7 8. Okay, how many? 8. 19 times 11 positive changes, 8 negative changes. Okay, number of runs is 8. Number of runs 80 is average, not within the average. First let us calculate mu. Step 1, basic information you have to write. 5 steps will be there. 5 or 6. 6 steps will be there. 6 steps. So 6 steps we have to do totally. First step will be, step number 1. First you have to write this. Okay, write down. After that, step 1, basic information, number of runs, positive and negative changes. Next, calculation of mu, means average, basic average without applying standard deviation. Okay, 2n1 n2 divided by n1 plus n2 plus 1. So we applied, we got 10.26. Okay, step 3, standard deviation. Apply the formula, n1 11, n2 8. Apply those numbers, calculate. We got 2.06. Means what? 10 plus 2.06, 10 minus 2.06. Wrong. This 2.06 will be multiplied with the amount called as a t. In the previous general example, I ignored the t for understanding sake. Okay. Next. First, in the question, they have given like this. You are required to test the weak form of efficient market hypothesis by applying the run test at 5% level of significance, 10% level of significance. Okay, if our estimations will be going wrong by 5%, if your estimates are going wrong by 10%, what will happen? That's a level of significance. Okay, values at 5% level of significance, you should use 2.101. T will be there na, that t will be 2.101. If you are applying 10% error, then apply 1.734. Simply to tell degree of significance is the t value. What value? T value. So they have given 18 degrees of freedom. How many? 18. In exam they will give 15 degrees of freedom also. Which one to take? 18 or 15? Sir, 18 degrees of freedom, 18 degrees, 15 degrees of freedom, 15, 13 degrees, 13, 21 degrees, 21 degrees of freedom. Which one you need to take? Here only 18 is there, now I will take 18. Therefore, for that also there is a formula. N1 plus N2 minus 1 is giving you the degree of freedom. N1 11 plus N2 18, 1 plus N2 8 minus 1, 11 plus 8 19, 19 minus 1 18. So 18 will be the right answer. Okay, like that you need to consider. T values you have to calculate. First mu we calculated 10.26. Standard deviation we calculate 2.06. Next we need to calculate T. T value is how much? It will be 2.101 if you take 5% of degree of freedom. So if it is 5% degree of freedom, okay, sorry, mu plus sigma into T. Sorry. Mu plus sigma into T. Mu 10.26 plus sigma 2.06 into 2.101. Like that we need to calculate. So we will calculate a higher limit, lower limit. 5.93 higher, 14.59 will be lower. So your average should be somewhere between 5.93 and 14.59. Okay, 5.93, 14.59. Actually, how many runs we have? 8. Average should be between 5.93 and 14.59. Our average 8 is between 5.93 and 14.59 or not? Yes. Therefore, this is at the 5% level of significance. 10% level of significance is 6.69 and 13.83. Even in this case, 18 is between both of them. 8 is between both of them. Number of runs 8. Okay. 8 should be between these two lower and upper limits. 8 should be between these two lower and upper limits. Lower and upper limits between it is there or not? Yes. Since the number of runs are between upper limit and lower limit, market is efficient and it is weak form. Who said it is weak form? Question only he said. This is a weak form efficiency. Weak form. That's all. This is how we have to calculate the concept relating to the efficient market hypothesis. Let me tell you the steps one more time. Step 1, basic information calculation. Number of runs, positive change, negative change, step 1. For that, first you need to draw this table and do. After that, mu. After that, sigma. After that, t value will be obtained on the basis of degrees of freedom. Degrees of freedom will be calculated as n1 plus n2 minus 1. After that, apply this. Finally, you have to give a conclusion. Okay. This is all with regard to the concept called as efficient market hypothesis. Okay. So, do one problem in the study material. You will get a full clarity on this. Okay. Thank you very much.